Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
AMETEK is a manufacturer of precision electronic instruments and electromechanical devices. It serves aerospace, defense, industrial, and medical customers, and it is one of the most consistent compounders in the industrial sector.
Founded in 1930, AMETEK became an acquisition-driven growth machine. Over 200 bolt-on deals later, it has built leadership positions in dozens of niche instrument markets across every major industrial vertical.
The business has two segments. The Electronic Instruments Group generates about 64% of revenue, making precision measurement equipment. The Electromechanical Group covers motors, interconnects, and specialty metals at about 36%.
The AMETEK acquisition strategy is distinctive. Management targets small companies with dominant positions in very narrow markets, then applies operating discipline to expand margins post-acquisition.
Operating margins run near 25%, exceptional for an industrial manufacturer. Free cash flow conversion is approximately 100% of net income. Return on invested capital runs around 12% and has been stable for years.
The moat is built on niche leadership. Every product line AMETEK manages holds either a number 1 or number 2 position in its specific segment. That concentration gives pricing power and makes substitution economically unattractive for customers.
CEO David Zapico has led AMETEK since 2016. He came up through the business unit side and continued the disciplined acquisition cadence. In 2022, the company bid for National Instruments but was outbid by Emerson Electric.
End market diversification reduces cyclicality. Aerospace and defense provide a stable government-funded base. Industrial automation adds commercial cycle exposure, and medical instrumentation adds a more recession-resistant component.
Organic growth typically runs 3 to 4% annually. The real growth engine is acquisitions, which have historically added 5 or more percentage points per year. The combination produces mid to high single-digit total revenue growth consistently.
AMETEK has raised its dividend for 30 consecutive years. The yield is modest at around 0.6%, reflecting the company's preference for retaining capital to fund acquisitions rather than maximizing dividend payout.
The competitive peer set includes Danaher, Teledyne, IDEX, and Roper Technologies, all serial acquirers of niche industrial technology businesses. AMETEK differentiates through instrument-focused concentration and a proven niche targeting playbook.
Products span over 100 countries, serving oil refineries in the Middle East, semiconductor fabs in Asia, and aircraft manufacturers in Europe. That breadth of application markets is part of what makes the platform so resilient.
The long-term investment case is built on compounding, consistent organic growth, disciplined acquisitions at attractive multiples, margin expansion through operational improvement, and steady free cash flow reinvested into the cycle.
AMETEK rarely makes headlines, but the fundamentals speak clearly. 25% margins, a 30-year dividend growth streak, and a proven playbook delivering exceptional returns across multiple economic cycles.
That's the company chapter for AMETEK. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
AMETEK just posted a record quarter that proves the niche industrial compounder model is alive and well. Q1 2026, revenue up 11% year over year to $1.93 billion. EPS came in at $1.97 versus the street's $1.90 estimate, a 3.7% beat. Operating margin 26.8%. Orders hit a record $2.2 billion. This is Charged Alpha. Let's break it down.
AMETEK is a $53.5 billion industrial conglomerate that designs and manufactures highly engineered electronic instruments and electromechanical devices. Think test and measurement equipment, precision motion control, advanced materials, and specialty motors, the kind of mission-critical components that go into aerospace systems, medical imaging machines, semiconductor process equipment, and defense platforms. They sell into niches where switching costs are high and where being the number one or number two supplier is the entire game.
The model is a textbook industrial compounder. AMETEK acquires niche businesses, applies operational discipline, expands margins, and redeploys cash flow into the next deal. Two reporting segments: Electronic Instruments Group, the larger and higher margin side, and Electromechanical Group, the precision motion and connectivity arm. Both grew this quarter, and both posted operating margin expansion. That is the AMETEK formula in one sentence.
Total revenue was $1.93 billion, up 11% from the year-ago quarter. Critically, and this is the number compounder investors zero in on, organic sales rose 5%. Acquisitions added another 5 percentage points, and foreign exchange contributed about 1 point. So the underlying business is growing mid-single digits with the M&A engine layering on top. Operating margin came in at 26.8%, exceptional for any industrial company at this scale.
Breaking out the segments, Electronic Instruments Group revenue was $1.26 billion, up 11%. Organic sales there grew 2%, with acquisitions contributing 7 points. EIG operating income reached $376 million, up 6%, with core margins expanding 40 basis points to 31.4%. That is best-in-class profitability for an instruments business.
Electromechanical Group was the standout. Revenue hit a record $664 million, up 13%. Organic sales there grew an impressive 11%. Operating income reached $171 million, up 33%, and core operating margin expanded 410 basis points to 26%. Whatever the bear case is on AMETEK, it is not the EMG segment right now.
Orders are the leading indicator, and they were the headline. Total orders reached a record $2.2 billion, up 23%, with organic orders up 22%. EIG organic orders grew 25%. EMG organic orders grew 16%. Backlog hit a new high of $3.87 billion. That is multiple quarters of revenue visibility loaded into the pipeline.
On the cash side, trailing 12-month free cash flow stands at roughly $1.7 billion. The balance sheet shows $458 million in cash against $2.3 billion in debt, for net debt around $1.8 billion. With $10.6 billion in equity and EBITDA running over $600 million per quarter, leverage is comfortable and gives management room for the next bolt-on acquisition.
Capital allocation is unmistakable. AMETEK does not pay a meaningful dividend and runs only a modest buyback. The cash goes into M&A. That is the entire reinvestment thesis. Recycle free cash flow into niche industrial businesses bought at reasonable multiples and improved through the AMETEK operating system. Management raised full-year 2026 EPS guidance to $7.94 to $8.14, implying 7 to 10% earnings growth.
The analyst breakdown is 7 buys, 6 holds, 0 sells. The average price target sits around $250 against a current quote near $233. That is roughly 7% upside to consensus, a modest premium that captures a lot about how Wall Street views this name. The lack of sell ratings tells you nobody disputes the quality. The hold-heavy distribution tells you everybody is wrestling with the multiple.
Forward earnings estimates run around $8.72 for 2026 and forward revenue at $8.4 billion. At a $53 billion market cap, AMETEK trades roughly 27 times forward earnings. For an industrial conglomerate, that is an outright premium multiple, closer to a software stack than a pure machinery company. The bulls argue that 26% operating margins and a proven M&A flywheel justify the re-rating.
The bullish thesis hinges on 3 things. First, the EMG margin expansion this quarter, 410 basis points of operating leverage, suggests there is still fuel for incremental margin gains. Second, the orders book at 23% growth points to accelerating demand into the back half of 2026. Third, the M&A pipeline is reportedly active, and every successful bolt-on adds compounding earnings power.
The hold-rated analysts are not bearish. They are price-disciplined. Their argument is that organic growth at 5%, while solid, is not screaming. Compare that to defense and aerospace pure plays growing organic at high single digits or low teens. So you are paying a compounder multiple for a business whose underlying organic growth is mid-single digit. The acquisition engine has to keep firing to bridge the gap, and that is the source of the valuation tension.
Worth noting, the post-earnings move was muted, down 0.5% despite the beat and the raise. That is consistent with AMETEK's history. Across the last 5 earnings prints, the average next-day move has been negative, even though every quarter included a beat. The market wants to see organic acceleration, not just steady compounding.
The bull case starts with niche industrial pricing power. AMETEK's products are sole source or dual source in markets measured in hundreds of millions, not tens of billions. That gives them durable price-cost spread and very high switching costs. Customers do not requalify a precision motion controller every quarter.
Second is the M&A flywheel. AMETEK has made over 170 acquisitions over its modern history, and the operational playbook is well rehearsed. Acquire, integrate, expand margins, redeploy. With $1.7 billion in trailing free cash flow, the engine has plenty of runway to continue compounding earnings even if organic growth stays in mid-single digits.
Third is aerospace and defense. AMETEK has meaningful exposure to commercial aerospace recovery and sustained defense spending, both secular tailwinds. The orders growth this quarter, particularly in EIG, was driven in part by these end markets. Combined with semiconductor process equipment exposure, AMETEK has multiple secular growth vectors layered into the business.
The bear case begins with organic growth. 5% is fine, but not exceptional, and at 27 times forward earnings, the stock is priced as if compounding will accelerate. If organic growth slows to 2 or 3% in any quarter, the multiple is exposed. AMETEK has historically traded at industrial conglomerate multiples in the high teens. The premium today assumes the compounder model continues to deliver flawlessly.
Industrial cycle is the second concern. Even with diversified end markets, AMETEK is ultimately tied to global capital expenditure cycles, semiconductor capex, industrial automation, process industries. A meaningful capex pause would show up in EMG bookings within 1 or 2 quarters, and we have seen that pattern in prior cycles.
Valuation is the third risk and arguably the biggest one. The stock is sitting close to consensus price targets with 7% of upside priced in. There is no margin of safety here for the long-term investor entering at current levels. Premium multiple compounders do not handle disappointing prints well, and even good prints with modest organic deceleration can pressure the multiple.
Finally, M&A integration risk. The compounder model only works if every acquisition is integrated successfully and accretively. With deal multiples drifting higher in 2026, AMETEK either pays up or walks away. Pay up and returns on capital decline. Walk away and the M&A engine slows.
Peer set: Honeywell, Emerson, Illinois Toolworks, and Roper Technologies. Among those, Roper's the closest spiritual analog. Roper also runs a niche compounder model, also trades at premium multiples, and is also debated on organic growth versus M&A grounds. Both have re-rated higher over the past decade as compounders earned multiple expansion.
Versus Illinois Toolworks, AMETEK is faster growing and more acquisitive, but ITW has higher returns on invested capital. ITW trades at a comparable multiple. The investor question is whether you prefer ITW's superior capital efficiency at lower top-line growth or AMETEK's M&A-driven compounding at slightly lower returns on capital.
Honeywell is a very different beast, much larger at over $130 billion market cap, more diversified and trading at a discounted multiple closer to 20 times. Honeywell offers more aerospace exposure but lacks AMETEK's niche industrial agility. Emerson sits in between, recently restructured around automation, and trades roughly in line with the industrial machinery group.
Bottom line on peers. AMETEK occupies the premium niche compounder bucket alongside Roper. Both command above-group multiples for proven M&A discipline and margin expansion. If you are constructing an industrial compounders basket, AMETEK and Roper are the natural pair. If you want lower entry multiples, Honeywell is the cyclical alternative with aerospace beta.
Options activity around the print was modest. Implied volatility leading into earnings priced roughly a 3% move. The actual realized move was smaller, under 1%, meaning option buyers got punished and premium sellers were paid. That is consistent with AMETEK's historical earnings pattern of low volatility responses despite consistent beats. The market views this name as a steady compounder, not a beta trade.
Open interest in the next two earnings cycles shows some modest call positioning at the 250 strike, the consensus price target, and put protection clustered at the 220 level. That suggests institutional managers are long the name through the earnings cycle, but hedging downside if organic growth disappoints. No outsized speculative flow either direction.
Insider activity has been routine. Senior executives sell shares through pre-scheduled 10b5-1 trading plans, which is standard for industrial conglomerates of this size. There have been no notable open market insider purchases in recent quarters, and no outsized sales beyond what equity vesting schedules would naturally produce. Read it as neutral, neither a buy signal nor a warning.
Institutional ownership is high, with the major index providers and active quality growth funds dominating the holder list. Vanguard, BlackRock, and T. Rowe Price are top holders. There has been steady accumulation by quality-focused active managers over the past several years, consistent with the broader trend of capital flowing into proven industrial compounders. Beta of 1.04 means it tracks the broader market closely.
Bottom line on AMETEK, elite niche industrial compounder, record orders, raised guide. The business is firing on every cylinder. Risk is the multiple, 27 times forward earnings prices in continued compounding.
If you own it, ride the M&A flywheel. New buyers should respect the premium. Charged Alpha rates this a quality watchlist hold. Outstanding compounder, full price. Wait for a pullback before adding.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall